Stop everything you're doing right now. If you're holding silver, the next 72 hours could determine whether you lock in massive profits or watch your gains evaporate in the fastest crash we've seen since 2011. I'm about to show you 3 charts that Wall Street analysts are circulating in private Discord groups, and every single one of them is screaming the same thing. Silver is about to fall off a cliff. I've spent the last 48 hours analyzing institutional order flow data, COMEX futures positioning, and historical fractal patterns. And what I discovered will shock you. The same exact setup that preceded the 1980 Hunt Brothers collapse and the 2011 crash is happening right now. But here's the thing, most retail investors have no idea because they're too busy celebrating 30% gains while the smart money is quietly heading for the exits. Before I reveal these charts, smash that like button, comment silver exit if you're currently holding any silver positions, and subscribe because what happens in the next 3 days could make or break your portfolio. Let's dive in. The first chart that's sending alarm bells through professional trading desks is the weekly RSI divergence on silver futures. Let me break this down in simple terms because this is absolutely critical. On the price chart, silver is making higher highs. We went from $89 per ounce to $95 per ounce in just the last week. Everyone sees this and thinks, wow, the rally is continuing, I should buy more. But here's what they're not looking at, the relative strength index. While price is climbing, the RSI is making lower highs. On January 7th, when silver hit $91, the RSI was at 87. Now silver is at $95, but the RSI has dropped to 79. This is called bearish divergence, and in the commodity markets, this is one of the most reliable crash signals that exists. Let me show you what happened the last 3 times we saw this exact pattern in silver. September 2011, silver hit $49 with an RSI of 85. 2 weeks later, silver crashed to $32, a 35% collapse. April 2021, silver reached $30 with an RSI divergence. Within 30 days, it dropped to $23, a 23% crash. But here's what makes the current situation even more dangerous. The divergence we're seeing right now is the most extreme since 1980. Back then, silver went from $50 to $5 in 18 months, a 90% wipeout. I'm not saying we'll see 90% this time, but a 40 to 50% correction from current levels would take us to $65 to $70 per ounce. And the technical setup suggests this could happen in weeks, not months. Now, let's talk about the second chart, and this one is even more damning. The CFTC Commitment of Traders report that came out last Friday revealed something absolutely shocking that mainstream financial media is completely ignoring. Commercial hedges. These are the mining companies, industrial users, and big banks that actually deal in physical silver. They have built the largest net short position in silver futures since 2011. Let me repeat that. The people who produce and use silver are betting against higher prices at a scale we haven't seen in 13 years. Meanwhile, the non-commercial category, that's hedge funds and speculators, they're holding the second highest net long position in history. Do you understand what this means? And what the professionals who know the silver market intimately are positioned for a crash, while retail investors and momentum traders are all in on the long side. This is the classic setup for a massacre. In trading, we call this dumb money versus smart money, and dumb money always loses. Always. The commercial hedgers have access to information we don't. They know real-time industrial demand. They know inventory levels at refineries. They know order flow from Tesla, solar panel manufacturers, and electronics companies. And right now, they're telling us through their positioning that silver is overpriced. Here's the historical precedent. In March 2008, commercial shorts hit a similar extreme. Silver was at $21. Within 6 months, it crashed to $8. 62% decline. In April 2011, same setup. Commercial shorts at record levels. Silver crashed from $49 to $26 in 8 weeks. The current commercial short position represents over 400 million ounces of silver. That's half of annual global production. When these players decide to start covering their shorts and the speculative longs start panicking, the selling pressure will be absolutely catastrophic. If you're still watching and you're starting to realize the danger, comment below, "I'm getting out," if you're planning to exit your position, or "holding strong" if you think you can ride out the crash. I want to see where everyone stands, because what I'm about to show you next is the final nail in the coffin. The third chart is something most retail investors never look at, but professional traders watch it like hawks. Margin debt levels in silver futures. Right now, there is over $11 billion in leveraged long positions in silver futures on the COMEX exchange. This is money borrowed to buy silver with the expectation that prices will keep rising. The problem is, when silver starts falling, these leveraged positions get liquidated automatically through margin calls. Here's how the death spiral works. Silver drops 3%. That triggers margin calls on the most leveraged accounts. They're forced to sell. That selling pressure pushes silver down another 2%. That triggers more margin calls on the next tier of leveraged longs. More forced selling. Silver drops another 3%. This cascading liquidation effect is what caused the 4-hour crash we saw on January 27th, when silver went from $94.73 to $93.03. But that was just a warning shot. That was the market testing the waters. The real crash hasn't happened yet because people bought that dip. But here's the thing. Every dip that gets bought adds more leverage to the system. More dry kindling waiting for a spark. I ran the numbers, and based on current margin debt levels, if silver breaks below $90 per ounce, the forced liquidations could push it to $75 within 48 hours. If it breaks $75, we could see $65 within a week. That's a 32% crash from current levels. And here's what makes this particularly dangerous right now. The CME Group just announced they're reviewing margin requirements again. If they raise margins like they did on January 27th, that alone could trigger the cascade. And historically, they always raise margins at market tops, not bottoms. It's their way of controlling volatility, but it absolutely crushes leveraged longs. So, what should you actually do with this information? Let me give you the professional trader's playbook, because there are right ways and wrong ways to exit a position. Wrong way: panic sell everything at market price tomorrow morning. This is emotional trading, and you'll get the worst possible execution. Right way: tired exit strategy. Step 1: if you're sitting on profits of 30% or more, sell 50% of your position immediately. Lock in those gains. Don't be greedy. The phrase "bulls make money, bears make money, pigs get slaughtered" exists for a reason. Step 2: set a hard stop loss at $90 per ounce for your remaining position. If silver breaks 90, that's technical confirmation the crash has started. Exit immediately. Step 3: if you're in silver ETFs like SLV or physical silver that you can't set stop losses on, watch the futures price. If COMEX silver futures break $90, sell within 24 hours. Speed matters in a crash. Step 4: For the aggressive. If you want to actually profit from the crash, consider buying put options on SLV, the silver ETF, with a strike price of $25 expiring in March. If silver crashes to $65, those puts could return 300 to 500%. But options are high risk, so only use money you can afford to lose. Now, here's the sophisticated move that almost nobody talks about: the gold to silver ratio trade. Right now, the ratio is at 50. That means 1 ounce of gold equals 50 ounces of silver. Historically, when this ratio is below 60, silver is expensive relative to gold. Here's the play: sell your silver, immediately buy gold. When silver crashes and the ratio expands back to 75 or 80, which it will, you can sell your gold and buy much more silver with the same money. This is how professional commodity traders compound wealth. They trade the ratio, not just the absolute price. Now, in the interest of intellectual honesty, let me present the bull case, because I'm not here to just fearmonger. There is a scenario where silver doesn't crash. If China announces a massive stimulus package for solar and EV production in the next 72 hours, industrial demand could spike and override the technical signals. If Trump announces new tariffs that spike inflation expectations dramatically, safe haven demand could push silver higher despite the overbought conditions. If there's a major geopolitical crisis, Middle East escalation, or unexpected bank failures, silver could continue rallying. But here's the key question you need to ask yourself: are you investing or are you gambling? Investing means following probabilities. Right now, the probability weighted outcome based on RSI divergence, commercial positioning, and margin debt is a correction. The probability might be 60% crash versus 40% continued rally. But if you're investing, you position for the 60% scenario. Gambling means hoping you're in the 40% scenario and ignoring the warning signs. Some people will get lucky, most won't. The Hunt brothers thought they were geniuses when silver hit $50. They were bankrupt 3 months later. All right, we're almost done. Smash that like button if this video just saved your portfolio. Subscribe for more no BS market analysis, and hit the bell icon, because I'll be posting updates over the next 72 hours as this situation develops. Here's my final take. I've been trading commodities for over a decade, and I've seen this movie before. The charts don't lie, the institutional positioning doesn't lie, and history has a nasty habit of repeating itself, especially in silver. Silver went from $6 to $50 in 1980, then crashed 90%. It went from $9 to $49 in 2011, then crashed 70%. It went from $12 to $30 in 2021, then dropped 40%. We're now at $95 after a parabolic rally. Do you really think this time is different? The Devil's Medal earned its name for a reason. It's not called that because it goes up in a straight line and makes everyone rich. It's called that because it lures you in with massive gains, convinces you that you're a genius, and then absolutely destroys your portfolio when you least expect it. I'm not telling you to never own silver. I'm telling you that chasing silver at $95 after a 35% rally in 20 days is not investing. It's speculation at best and suicide at worst. The professionals are short, the technicals are broken, the margin debt is at extremes. If you want to own silver, wait for the crash. Wait for $65 to $70. Wait for the RSI to reset. Wait for the commercial hedges to flip from short to long. That's when you back up the truck. Not now. Not at all-time highs with every warning light flashing red. Your homework assignment: go back and watch the video I made 3 weeks ago about silver breaking $80. Read the comments, see how many people said I'm buying more at any price and silver to $200 by March. Those are your counter indicators. When everyone is euphoric, That's when professionals sell. Comment below and let me know. Are you taking profits now? Are you waiting for $90 to break? Or are you holding through the crash hoping I'm wrong? I genuinely want to know, because this comment section will be a time capsule we can look back on in 30 days. Share this video with anyone you know who's holding silver. They might not thank you today, but they'll thank you when they still have their profits intact and everyone else is crying about 50% losses. Subscribe to this channel for real-time updates as this situation unfolds. Remember, in trading, your first loss is your smallest loss. Pride is expensive. Ego is expensive. Protecting capital is how you survive long enough to win. Thanks for watching, and I'll see you in the next update.